In a prior discussion, we discussed gross domestic product, that is the final market value of all goods and services produced in a period of time, and that there's an income and an expense approach, and we focused on the expense approach. Today, in this video, what we'll discuss is the income approach to measuring gross domestic product. One person's expense is another person's income, so these two approaches should be equal. It's called national income accounting because all like-minded transactions will be put together. And there are various subtotals here which tell us about important things in the economy. And by doing this, we'll be able to adjust economic performance if, for example, this $9,666 billion GDP is recessionary. There are some things we can change in here to make that number change and improve. So let's begin reviewing GDP income approach. All right. So let's say we've got a GDP of $9,966 billion. You can look at that as total income. And you know that you're not going to get your total income on your paycheck because they're going to take out taxes and things like that. And so what we're trying to do is figure out how much do you get, what's left after all these adjustments are made, which then goes back to this consumption number here is this consumption number. So if we take $1,257 billion out of this, we'll get a subtotal of $9,709 billion, and this statistic is called net domestic product. We're subtracting something called consumption of fixed capital, which is also known as depreciation. There are some economists who want to know what the total spending in an economy is, and that'll be $9,966 billion. But there are economists who are saying, well, yeah, that's true. We spent a lot of money in there on business equipment, but some of the old business equipment wore out. It depreciated. And so how large was our spending last year once we adjusted for the wearing out of business equipment that lasts more than 1 year, depreciation? And that's what you would use this statistic for. Now, from $8,709 billion, we want to get down here to national income. National income is also known as earned income. It's payment to the four factors of production: land, labor, capital, and entrepreneurship. Now, they're doing something sneaky here. This is a domestic number. This is a national number. And if you recall from the prior discussion, we have two statistics, one called gross domestic product and one called gross national product. Gross domestic product is anybody, a U.S. citizen or a foreigner, that is producing goods and services in the United States. So foreigners in the United States, Ohio, Honda making cars in Ohio, for example, would be gross domestic product, this number. But here we want a national number. A national number are Americans anywhere in the world, where the United States or a foreign country. So to get this national number, we're going to have to subtract these people out and add these people in. We no longer want Honda in Ohio, and we instead want to focus to include, for example, General Motors in China, and that will convert our domestic number into a national number. Now, also what we want to do to get to national income is subtract out something called indirect business taxes. These, for example, are sales taxes. They're collected, they're charged, it's an expense, but they aren't kept by the factors of production because they collect them at sales but have to turn them over to the government. Your sales tax, for example, of 8.65% is collected by businesses but not kept by the owners or the labor or capital or natural resources. And so we have to subtract that out from this number to get to earned income. Wouldn't it be nice to know how much Americans made regardless of where they were in the world? And that's what this is. Now, from here we want to get to something called personal income. This would be like your gross pay. Just because you get income doesn't mean you get to spend it, consume it. Social Security taxes, for example, including Medicare and Social Security, that's 7.65% of your gross pay that you're not going to get to keep. So we're going to subtract out $706 billion on our way to getting to personal income. Corporate income taxes have to be paid of $286. So an entrepreneur may make a certain amount of money, but they aren't going to get to keep it because some of that money will have to be paid in taxes. So, for example, a corporation has total sales. You have to subtract out costs, and that gives them profit. But they have to pay a tax on that profit, and that's called net income. So it's this tax we're subtracting out. The next line item in the National Income Approach is undistributed corporate profits. So businesses make profits, and what can happen to those profits, as we just mentioned, are first, the corporation has to pay a tax on it. And then we have something called net income. Now, a corporation can do two things with their net income. They can keep it, and they can use that money to expand the operation of the company. That's called retained earnings. Or the company can pay the profits out to the owners, and that's called a dividend. So some of this money is going to be undistributed corporate profits. You won't get it to spend. So we're going to subtract out $274 billion. Now, there are some people who get income but didn't earn it, and that's like welfare, food stamps, housing subsidies. So this would be transfer payments. Well, maybe not housing subsidies. So you're going to take $1,530 billion and add it into this number, and now we have personal income of $8,282 billion. Sadly, you don't get to spend that either because you have to pay income tax on that money. So if we subtract out $1,292 billion from our personal income, we'll arrive at a statistic called disposable income of $6,990 billion. There are only two things you can do with disposable income: consume it or save it. This is actually the amount of your net pay. And now, we know from a prior example that consumption was $6,759 billion. So we can take that from the expense approach and put it here in the income approach. And if we take $6,990 billion and subtract out $6,759 billion, we have determined that savings is $231 billion. So, to summarize, one of the values of doing this is that gross domestic product expense approach is made up of consumer spending, business spending, government spending, and imports, exports. If this is a recessionary level of GDP, it would be possible to adjust this consumption number, perhaps by lowering corporate income taxes, by lowering personal income taxes, reducing FICA tax, Social Security and Medicare, and that would cause consumption to rise, and we might be able to spend our way out of a recession. There is a worksheet that discusses how to calculate this that you should look into and do. Also on that worksheet is how to calculate national income a second way, where you were provided with the four parts of the earned income: land, labor, capital, and entrepreneurship, and the four payments that they earn: rent, wages, interest, and profits. So take a look at that worksheet and see if you can calculate GDP, expense, and income approach.